Welcome to the Deep Dive. We're here to help you navigate the often confusing world of modern enterprise tech and strategy.
And today we're tackling something huge. It's arguably the biggest business paradox of 2025.
That's right. We're talking about this profound disconnect. It feels structurally unsustainable between all the hype around AI and what's actually happening on the ground with implementation.
It really is the defining financial, maybe the chasm of the decade. You've got this incredible flood of capital on one side, a spending supercycle, really.
Driven by what? Competitive pressure, fear, opportunity?
All of the above, I think. But then you look across that chasm, you look at the companies actually trying to get a measurable return from AI, and, well, it's often a disaster zone.
Yeah, let's put some numbers on that right away, because they really frame this whole paradox. We're seeing massive big tech, capital expenditure, CapEx, Microsoft, Alphabet, Amazon, Meta. They hit a combined $320 billion in 2025. Just think about that number.
And that's up massively, right? From like $230 billion the year before?
Exactly. Almost $100 billion more in just 1 year. The investment curve is, it's practically vertical.
But then the reality check, on the ground, the results, almost universally disappointing, wouldn't you say?
It seems so. We've got multiple credible studies pointing this out, that big one from MIT, for instance.
Yeah, the MIT analysis, it found that up to, 95% of generative AI initiatives are failing to deliver any measurable impact on the P&L, the profit and loss.
Failing to move the needle.
Right. They're just not showing up in the financials.
95% failure. While at the same time, trillions are being committed to the underlying infrastructure. So that's our goal today, isn't it? To really analyze this gap. We need to understand why all this money is flowing, seemingly faster than ever, but the tangible ROI, the return on investment, is just so hard to find.
And critically for you listening, the goal is to pull out a strategic playbook from all this. How do we move from this endless cycle of hype to, actual successful execution?
What's the first big takeaway then? If someone tunes out after 30 seconds, what should they know?
Okay, the absolute key thing is this. This is not primarily a technology problem. The algorithms, they're incredibly powerful. The hardware, it's becoming more available despite bottlenecks.
Right.
This is fundamentally a business transformation challenge. It's rooted in, failed strategy, shaky data foundations, and maybe most importantly, a deep resistance to cultural change inside large organizations.
Okay, so strategy, data, culture, not the shiny tech itself. Let's dive into that first section then. The $1 trillion paradox, investment versus return.
Right.
Let's really unpack the sheer scale of this investment first. That $320 billion collective CapEx. Companies are essentially betting the farm on winning the compute race, aren't they? Why such a sudden, massive explosion in spending?
It really feels like a land grab, doesn't it? A grab for future capacity. They're buying up specialized hardware like crazy, mostly GPUs and now custom AI accelerators, to train and run these huge foundation models.
Like Microsoft's projection, you mentioned that earlier.
Yeah, look at Microsoft. They're projecting CapEx of over $30 billion, not for the year, but just for the first quarter of fiscal 2026. And most of that is earmarked for specialized hardware, like their own Azure Maya AI accelerators. This isn't just keeping the lights on. This is building capacity for years out. They're buying the horsepower needed to stay in the game for the next 5, maybe 10 years.
And it's not just the big cloud providers funding their own build-out, is it? The partnerships are locking up future supply, too.
Absolutely. You see these huge commitments, like the reported $100 billion partnership between NVIDIA and OpenAI.
Or Oracle's move.
Exactly. Oracle making a staggering $40 billion commitment to buy, 400,000 of NVIDIA's latest GB200 chips.
That's an enormous bet.
It is. And the physical impact is real. We're building the backbone of this AI ecosystem so fast that data center construction, just the building itself, is now estimated to be contributing something like 1 percentage point to U.S. GDP growth.
It's physically reshaping the economy.
Yeah.
Wild.
And the investment world sees it too, right? The VCs are all in. Global venture capital investment in AI companies went over $100 billion back in 2024.
And the latest figures for 2025.
By 2025, AI startups were grabbing 26%, more than a quarter of all global VC funding. That tells you the broader market, beyond just big tech, is utterly convinced this is the next big thing, the next industrial revolution, basically.
Okay, so the commitment is there. The money is flowing like a tidal wave. Billions, maybe trillions overall. Why then are the actual enterprise returns so, So pathetic in comparison.
Yeah.
Let's pivot to that sobering ROI crisis.
Right, the other side of the coin.
We mentioned the MIT study, 95% seeing zero return on Gen AI investments. And that's despite companies spending, what, $30 to $40 billion specifically on these enterprise projects.
And that 95% number, unfortunately, seems consistent. Look at other data points. One survey found 42% of enterprises reporting zero ROI from any AI deployment, Gen AI or otherwise.
42% getting nothing back.
Nothing. And another 29% reported only modest gains. So add that up. Nearly 3/4, maybe 71% of all enterprises are basically breaking even or actively losing money on their AI projects.
And these aren't cheap projects, right?
Not at all. The average AI initiative costs around $1.9 million, according to some studies, and most of them are simply failing to justify that cost on the bottom line.
So that brings us to this idea. You mentioned the unsustainable gap. Can you explain that? The Sequoia analysis touched on this, right?
Yeah, the Sequoia analysis really highlighted the financial dissonance. In 2023, the industry spent roughly $50 billion on NVIDIA chips, mostly for training these huge models.
Okay, $50 billion in.
But those chips, or the services they enabled, only generated about $3 billion in new revenue attributable to AI.
$50 billion in, $3 billion out.
Yeah. That's a dismal 6% return on that specific hardware investment linkage. Obviously, it's a simplified view, but directionally, it's stark.
And that low return leads to this concept of a potential, what was it, a $500 billion hole? That sounds alarming.
It is a strategic risk, yeah. Analysts looked at the current incredibly aggressive pace of infrastructure investment, all the CapEx we talked about.
Right.
To actually justify those spending levels, to pay back those massive CapEx bills over time, the industry probably needs to generate something like $600 billion in annual AI-related sales.
$600 billion a year. And where are we now?
Well, optimistic projections for current actual AI sales are maybe hovering around $100 billion. So the $500 billion difference, that's the hole. It's the gap between the market expectations baked into those investments and the current enterprise reality.
So the market is capitalizing a future that just hasn't arrived yet in terms of widespread enterprise value.
Precisely. The value is projected, not yet realized by the end customers paying the bills.
Okay, but given this huge gap, this lack of end-user return, it feels like the whole structure should be shaky. How is the market sustaining these incredible valuations for big tech, for the hardware makers like NVIDIA, for the AI startups?
Well, that's where this ingenious, maybe slightly precarious circular financing loop comes in. It's a bit of a closed system, almost self-reinforcing.
Okay, break that down for us. Who are the players in this loop?
Think of 4 main groups. 1, the big cloud providers, Microsoft Azure, Amazon AWS, Google Cloud. 2, the key hardware suppliers, primarily NVIDIA right now. 3, the hot AI startups like OpenAI, Anthropic, Cohere, etc. And 4, the venture capitalists funding those startups.
Okay, cloud, hardware, startups, VCs. How do they connect in this loop?
Right. So the cloud providers are massive buyers of NVIDIA chips. They account for well over 40%, maybe even 50% sometimes, of NVIDIA's revenue. They need the hardware for their own services and to rent out.
Got it. Cloud buys from hardware.
Then these same cloud providers, often alongside major VCs, are the primary investors pouring billions into the AI startups. Microsoft's investment in OpenAI is the classic example.
Okay. Cloud and VCs fund startups.
Now, the startups, flush with this new venture capital cash, what do? Immediately? They turn around and spend a huge chunk of it.
Let me guess. On compute power.
Exactly. They spend it renting the necessary cloud infrastructure, which means buying cloud services, often running on NVIDIA hardware, frequently from the very same big tech companies that just invested in them or partner closely with them.
Ah, I see. So the money flows from cloud VCs to startups.
Yeah.
And then immediately back from startups to cloud hardware providers.
Precisely. It creates this cycle where the financial success, the revenue growth for the cloud providers and NVIDIA, and the valuation bumps for the startups are all interconnected. And this is the key point, that entire cycle can operate for a while at least, somewhat independently of whether the ultimate end user, the enterprise customer trying to deploy the AI, is actually getting significant value or ROI.
So the structure props itself up based on investment flowing within the circle, not necessarily on value delivered outside it.
That's a good way to put it. It artificially inflates valuations across the board, hardware, cloud, startups, even if the final corporate customer isn't seeing the benefits yet.
And this kind of masks what you call the productivity paradox.
It does, yeah. Because we do see widespread adoption of certain tools. Maybe 80% of organizations have experimented with things like ChatGPT or Microsoft Copilot.
And those tools do seem to help individuals, right?
Absolutely. They can boost individual productivity. A marketer might draft ad copy faster. A developer might write boilerplate code more quickly. That's real.
But
And this is the crucial distinction, that individual efficiency gain has proven incredibly difficult to translate into measurable, scaled P&L performance for the enterprise as a whole.
how so? If individuals are faster, doesn't that help the company?
Not automatically. You might save an employee, say, 15 minutes a day. But if that saved time just gets absorbed into, slightly longer coffee breaks or checking email again, and it doesn't lead to a structural change like handling more customer volume with the same staff, or reducing project turnaround times significantly, or enabling fundamentally new outputs, then the enterprise balance sheet doesn't really notice.
So you get this illusion of progress at the individual level,
Right.
but no concrete financial results for the company overall.
That's the paradox. Lots of activity, lots of tool usage, but limited bottom line impact so far for many.
Okay, that failure to translate individual gains into corporate profit really leads us into the next area. The anatomy of why these enterprise projects are failing so often.
Right, the operational reality.
And the failure rate seems to be getting worse, not better. We saw that number. Companies abandoning most of their AI initiatives jumped dramatically, from 17% doing that in 2024.
To an alarming 42% in 2025.
That's a huge leap. 147% increase in just 1 year.
Yeah.
It feels like companies really hit a wall in 2025.
They absolutely did. I think they discovered what some people call pilot purgatory. They get stuck.
Pilot purgatory, explain that.
It means companies are stuck in these endless testing phases. The initial proof of concept, the POC, looked promising in a controlled lab setting. But then they try to scale it, to integrate it with real-world, messy systems. And it just doesn't work reliably or cost-effectively.
So they just scrap the projects.
A huge number, yes. On average, organizations are scrapping something like 46% of their AI proofs of concept before they even get close to a production deployment.
Almost half of POCs die before launch.
Yeah. And if you look at the ones that do get approved to move forward from the pilot stage, the cold, hard truth is that only about 1 in 8 of those actually become fully operational, scaled capabilities.
1 in 8 pilots makes it. So that's like an 88% failure rate just for the pilot to production phase.
That's right. It's incredibly high.
And you've argued the root cause isn't usually that the AI model itself is flawed, but something you call implementation debt. What exactly is that? What does that debt look like?
Implementation debt is basically the accumulated cost of all the strategic shortcuts companies took during that initial hype frenzy, say, late 2022, early 2023.
When everyone was rushing to do something with Gen AI.
Exactly. Executives felt pressure. We need an AI strategy. Launch some pilots. So they rushed into POCs, often using carefully curated, clean, maybe siloed data sets in a nice, controlled sandbox environment.
Okay, it makes the POC look good.
Right. But the debt is all the foundational work they skipped. Things like mapping out and improving poor API integrations between systems, tackling the fact that critical data lives in dozens of incompatible silos across the company, the complete lack of robust metadata standards or data lineage tracking.
So you don't know where the data came from or how reliable it is.
Precisely. All that unsexy plumbing work got bypassed in the rush.
So then the pilot looks successful in its little sandbox. They say, great, let's scale this. Let's integrate this AI with our ancient legacy financial system or our chaotic supply chain database.
And boom, they hit the wall. The systems aren't properly mapped, the data isn't standardized or trustworthy, the APIs are flaky. The AI model, which worked fine on clean data, breaks down because it suddenly needs a human translator or constant manual intervention just to function in the real messy environment.
And the cost of fixing all that after the fact.
That's the debt coming due. The cost of cleaning, governing, standardizing, and integrating the data after the project has already started often balloons, sometimes exceeding the entire initial projected ROI of the AI project itself. They realize they have to rebuild the foundation before they can put the roof on.
Which points us directly back to what you said at the start. The failure is overwhelmingly organizational, not technical. And the number one barrier cited is
Foundational data deficiencies. It comes up again and again.
what percentage of companies admit this?
A staggering 57% of companies openly admit their data simply isn't AI ready.
And AI-ready doesn't just mean clean data, right?
No, it's much more than just accuracy. It's about fitness for purpose. Does your data have the right context? Do you know its lineage? Where did it come from? How was it transformed? Who touched it? Is it standardized across different business units so the AI can see a coherent picture? If the answer is no to these questions, the AI model just cannot function reliably or make trustworthy decisions at scale.
And Gartner has a prediction on this, right? About project abandonment due to data issues.
They do. They projected that at least 30% of Gen AI projects will be abandoned by the end of 2025, specifically because of issues with data quality, data governance, and the lack of lineage tracking. It truly is the Achilles heel of this whole enterprise AI push.
Okay, so poor data is barrier number one. What else contributes to this implementation, debt and failure? You mentioned the MIT study identifying a learning gap and brittle workflows.
Right. This is another key piece. Most generic AI models, especially the large foundation models, are essentially static once they're trained. They don't continuously learn from feedback in a specific enterprise context unless you build complex, costly systems around them.
So you layer this static model onto a really complex, messy, constantly changing business process.
And the model becomes brittle. That's the term MIT used. It means it works okay for the standard cases it was shown, but as soon as a small, unexpected variable pops up, a new product code, a weird customer request format, a temporary supply chain issue, something not in the training data or rules, it fails, often spectacularly. It either gives a nonsensical output or just stops, forcing a human to jump in and fix it or handle the exception manually. That completely kills the automation loop and erodes any efficiency gains.
And this brittleness explains why adoption is so low despite evaluation.
It's a major factor. Studies show something like 60% of organizations evaluate these enterprise-grade AI systems, but only around 5% actually manage to successfully deploy them widely. That gap is largely due to this brittleness when hitting real-world complexity.
Okay, data issues, brittle workflows. What about the human factor? There's this concept researchers are calling work slop. We talked about the productivity paradox, how individual gains don't always translate. How does work slop actually make things worse sometimes?
Work slop is essentially low-quality, often subtly flawed, AI-generated content that creates more work downstream, not less. It creates this false sense of completion.
Give me an example.
Okay, imagine an AI drafts a complex report or a legal document. It might get it, say, 80% correct, which sounds good.
Yeah, seems so.
But the remaining 20% isn't just typos. It might contain subtle factual errors, logical inconsistencies, or misinterpretations of nuance that require really intensive, time-consuming human review, fact-checking, and careful editing by an expert.
And because the AI output looks polished and complete.
Exactly. Because it looks plausible on the surface, the human reviewer often has to spend more time scrutinizing it, questioning every detail, than if they had just started from a rough human draft or even a blank page. The cognitive load is higher.
So the burden of correction gets shifted downstream, creating new, often unmeasured costs and frustrations.
Precisely. It frustrates employees, makes them feel like glorified proofreaders for a machine, and ultimately erodes trust in the AI system itself. It's sloppy work pawned off by the AI onto the human.
And that frustration must feed directly into the cultural resistance we talked about.
Absolutely. You've got resistance from frontline employees who see this work slop and also fear their jobs are being devalued or eliminated. And then you have significant apprehension, often unspoken, from middle management.
Why middle management specifically?
Well, they're often the crucial gatekeepers for implementing any real process change. But they might fear losing control over their teams or processes. They might worry about the reliability of the AI, or they might fear that if the AI streamlines things too much, their own role becomes redundant. They can subtly or overtly block adoption if they aren't brought into the process.
It really underscores that 70% people and process rule we'll get to later.
It really does. And there's one more structural challenge worth mentioning, what we might call the enterprise paradox of scale.
Okay, what's that paradox?
The paradox is that the very largest companies, the ones with the most resources, the most data, the most capital, they actually lead in the sheer volume of AI pilots they launch. They experiment a lot, but they significantly lag behind smaller, more agile companies when it comes to actually scaling those pilots into production and achieving business impact.
That seems counterintuitive. Shouldn't big companies with all their resources be better at scaling? Why is the friction higher for them?
It boils down to inertia and complexity. Scaling in a large, established enterprise means wrestling with decades of complex, tangled legacy IT systems. It means navigating rigid, often siloed bureaucracies where different departments don't share data or cooperate easily. It means overcoming deeply entrenched ways of working.
Whereas a smaller, younger company.
A smaller, more agile company, especially a digital native one, might be able to build AI-ready processes and data structures almost from scratch. They don't have the same weight of legacy holding them back. Large companies are essentially trying to renovate a historic mansion while living in it, whereas startups are building a new house on an empty lot.
And the internal friction is so bad that external partnerships sometimes work better.
Yeah, there's data suggesting that large enterprises that partner with external specialists for implementation see roughly twice the success rate compared to those trying to build everything purely internally. The external partner can sometimes bypass the internal politics, bureaucracy, and skills gaps more effectively.
Fascinating. So the scale itself becomes a barrier to scaling AI successfully. Okay, this collective struggle, this high failure rate, it must be leading to a shift in the market sentiment, right? We can't stay in peak hype forever.
No, absolutely not. And we are definitely seeing that shift. The irrational exuberance of, say, late 2023 is giving way to a much more sober reality check in 2025.
And the big consulting firms are tracking this. Gartner's hype cycle, for instance.
Exactly. Gartner officially placed generative AI squarely in the trough of disillusionment on their 2025 hype cycle. It had a meteoric rise up the peak of inflated expectations, maybe the fastest ever. But now it's hit that inevitable phase where the initial promises collide with the harsh realities of implementation.
The phase where the tech vendors may be overpromised, and the executives are realizing just how complex and costly paying down that implementation debt really is.
That's the trough in a nutshell. And you hear the frustration directly from executives now. We're hearing quotes like, I just don't know why it's taking so long. We've spent all this money on AI. It's just not happening fast enough.
That kind of sentiment signals the end of the purely speculative, easy money phase, doesn't it?
It does. But we need to be really clear here. This isn't necessarily an AI winter or a total crash. It's better described as a rolling correction or a maturation.
What do you mean by rolling correction?
It means the market is shifting gears. It's moving from a speculative hype cycle, driven by potential, towards an execution-focused adoption cycle, driven by proven results, the froth, the maybe overhyped consumer apps, the less essential bells and whistles that's getting skimmed off. Investment is becoming more discerning.
But the core infrastructure and high-value applications are still strong.
Absolutely. Foundational infrastructure spending remains robust, driven by that land grab we discussed, and investment in high-value, industry-specific AI solutions, think drug discovery, advanced materials science, complex engineering simulations, sophisticated fraud detection that remains red hot. Why? Because those applications solve very real, measurable, high-value business problems. The money is flowing towards demonstrable ROI now, not just hype.
And interestingly, it's not just market sentiment applying the brakes. There are real-world physical constraints starting to bite, right? The whole environmental and energy aspect.
This is becoming a huge non-negotiable factor. The compute demands of training and running these large AI models are just staggering. They require absolutely enormous amounts of electricity.
And water, too, for cooling the data centers.
And vast quantities of water, yes. The projections are pretty sobering. Some suggest that by 2030, the power consumption of the AI infrastructure globally could be equivalent to something like 70% of all U.S. electricity usage back in 2024.
70% of 2024 U.S. usage just for AI by 2030. That's incredible.
It's a massive strain, and it's already exposing real bottlenecks in electricity grids in key regions. It's leading to delays in getting new data centers powered up. It's forcing companies to think much harder about energy efficiency.
Okay, but why should someone listening who's maybe focused on their department's Q4 budget or hitting a specific project milestone care deeply about national grid capacity or water usage? How does that translate to their immediate concerns?
It translates directly to cost and strategic risk. If electricity prices rise due to demand, or if grid access becomes constrained and allocated, the operational cost of running AI models skyrocket.
So inefficient AI becomes prohibitively expensive.
Exactly. If your AI initiative is computationally inefficient, if it requires excessive compute power per transaction or per insight generated, if it can't demonstrate provable high-margin profitability to justify that energy cost, it's going to be the first one on the chopping block when resources get tight.
I see. So physical resource constraints, power, water, grid access are rapidly becoming a financial constraint and a strategic filter. It's not just about having the capital anymore. It's about having the efficient workload and the access to run it.
Precisely. It forces a focus on efficiency and true ROI, not just speculative potential. It makes strategic, efficient adoption an absolute necessity for long-term survival in this space because the resources simply won't be there for wasteful approaches.
That need for efficiency, for real value, brings us to the latest twist in the hype cycle. The rise of so-called agentic AI and the very dangerous practice of agent washing.
Yes, this is the new frontier, both in terms of potential and, unfortunately, in terms of marketing deception.
Let's start by defining terms. What is a true AI agent? How is it different from, say, a chatbot or a co-pilot?
A true AI agent represents a significant leap. It's defined by its goal-driven autonomy. This means it's designed to achieve a specific objective. To do that, it needs several key capabilities. It has to be able to perceive its environment, like reading emails, monitoring system alerts, reason over complex, context-aware information, not just follow simple rules, make independent decisions based on that reasoning, and then crucially initiate and manage actions across multiple different systems or applications with minimal human intervention.
So it's not just assisting a human within one application like a co-pilot. It's orchestrating a whole workflow.
Exactly. Think of it less as a tool you wield and more as a digital team member you delegate a complex task to, which might involve interacting with your CRM, your email, your inventory system, and maybe even external websites, all to achieve a single goal like resolve this customer shipping issue. It has agency.
Okay, that sounds powerful. But that's not what's always being sold, is it? This is where agent washing comes in.
Unfortunately, yes. Vendors are jumping on the agent hype train. They're taking much simpler, often pre-existing tools and just rebranding them, sticking an AI agent label on them.
What kind of simpler tools are getting washed?
Well, you see basic co-pilots being called agents, even though they're typically confined to assisting within a single application, like a specialized writing assistant in your word processor. That's not orchestration.
What else?
Simple, rule-based chatbots, the kind that just follow a predefined decision tree to answer common questions. They have no real reasoning or autonomy, or even older robotic process automation, RPA tools.
RPA. That's just screen scraping and following scripts, right?
Pretty much. RPA just automates repetitive, predictable tasks by mimicking human clicks and keystrokes. It follows a rigid script. There's no perception, reasoning, or decision-making in the true AI sense. But vendors are now calling these basic automations agents. They're using the language of autonomy without delivering the actual capability.
And how widespread is this agent washing? You mentioned a Gartner finding.
It's quite shocking, actually. Gartner analyzed thousands of vendors who were claiming to offer agentic AI capabilities. They found that only approximately 130 of them, that's less than 5%, offered product that genuinely met the criteria for true goal-driven agentic capability.
Less than 5% are the real deal.
Yeah.
That should be a massive red flag for anyone buying AI solutions right now.
A huge red flag. Buyer beware. Absolutely.
And the consequences of falling for agent washing are pretty severe, aren't they? Wasted investment seems guaranteed.
Guaranteed. Gartner predicts that over 40% of projects based on supposed agentic AI will be canceled by 2027 simply because the washed products will fail to deliver on the inflated expectations set by the marketing. The tool just won't be able to do what the salesperson claimed.
And beyond wasted money, are there other risks? You mentioned paving the cow path.
Yes, that's a significant strategic risk. If you deploy a washed tool, say a simple RPA bot dressed up as an agent to automate an existing, maybe inefficient or broken business process, you risk paving the cow paths.
Meaning you just automate the existing dysfunction.
Exactly. You lock in that inefficiency at scale, making it even harder to fix the underlying process later. Instead of rethinking and improving the workflow using true AI capabilities, you've just made the old, bad way of doing things run faster.
And regulatory risk, too.
Yes, that's emerging as well. Regulatory bodies like the U.S. Federal Trade Commission, FTC, are starting to take action against companies making false or unsubstantiated claims about their AI systems' capabilities. Error AI was one example that got cited. So deploying a tool based on deceptive marketing could lead to legal and reputational trouble down the line.
So the message for the listener is extreme vigilance when vendors start talking about agents.
Absolutely. You need to dig deep, ask hard questions, demand proof, and understand exactly what level of autonomy and reasoning capability you are actually buying versus what's just marketing fluff.
Okay, so enterprises are struggling with data, debt, brittle workflows, and now deceptive agent washing. It sounds like a mess. But amid all this struggle, one sector seems to be doing incredibly well, almost feeding on the confusion.
Ah, yes. The consultants.
The consultant gold rush. It really reflects how desperate companies are for guidance through this AI maze, doesn't it?
The revenue numbers are just staggering. They tell the story of enterprises throwing money at the problem, hoping for answers. Look at the big five consulting firms. Accenture, for example.
Well, Gen AI revenue.
They reported $4.1 billion in Gen AI-related revenue for their fiscal 2024. Compare that to only about $300 million the previous year. It's explosive growth.
And others. BCG McKinsey?
Boston Consulting Group, BCG, now says that 20%, one-fifth of its total firm revenue comes from AI-related work. That's up from practically zero just 2 years ago. McKinsey expects AI work to be 40% of its entire business within the next few years.
Wow. They are clearly the immediate financial winners in this period of enterprise confusion and failure.
They absolutely are. They're selling the maps for navigating the territory that companies are getting lost in.
But the silver lining here is that because these firms are working with hundreds of companies on these AI projects, seeing the failures firsthand, they've developed a pretty clear, unified view on what does work. There's a strategic consensus emerging.
There really is. Their collective experience has forged a powerful roadmap for success. It's remarkably consistent across the major firms.
Let's unpack that consensus.
Yeah.
Starting with BCG's famous framework, the 10-20-70 rule. What's that about?
This rule really forces a fundamental shift in focus and budget allocation. BCG analyzed successful AI implementations and found a consistent pattern. Success is determined only about 10% by the specific AI algorithms or models you choose.
Only 10% for the core tech.
Only 10%. Another 20% of success depends on the supporting technology and data infrastructure, getting the cloud platform right, having the right data pipelines, etc.
So that's 30% for all the tech and data stuff. Where's the rest?
The massive variable, the remaining 70%, hinges entirely on people and processes. It's about change management, workforce reskilling, redesigning workflows, getting buy-in from employees, and strong leadership commitment.
70% people and process. That's huge.
It's huge. And BCG argues that the leaders who succeed are the ones who recognize this. They focus intensely on fewer high-impact use cases tied directly to core business processes, and they dedicate the vast majority of their effort and budget, that 70%, to managing the human and organizational change required to make the AI actually work in practice.
That connects directly to what McKinsey diagnosed as the Gen AI paradox, right? High adoption of tools, but low impact on the bottom line.
Exactly. McKinsey saw the same thing. Lots of companies using AI tools, but very few seeing significant earnings improvement. Their solution aligns perfectly with the 70% rule.
What's McKinsey's prescription for solving the paradox?
They say the key isn't just plugging in new tools like Copilot into existing jobs. That just automates parts of the old process, often leading to that work slot problem. The solution is to fundamentally rewire the core workflows themselves.
Rewire, meaning?
Meaning you have to rethink the entire process. How does the human role change? How do team structures need to adapt? What are the new key performance indicators, KPIs, that measure success in an AI-augmented workflow? It requires structural reorganization and redesigning jobs and processes around the new capabilities that AI unlocks. If you just automate slices of the old job description, you get incremental gains at best, maybe even negative impact. If you rewire the workflow, that's where you can potentially get the transformative P&L impact.
Okay, so BCG focuses on the 70% budget allocation, McKinsey on rewiring workflows. What about Deloitte? They talk about positive pragmatism.
Deloitte brings in the element of market maturity and managing expectations. They noted that cooling executive enthusiasm, we talked about the C-suite, realizing this is harder than they thought. That's the pragmatism part.
And they saw a shift in the barriers companies were citing.
Correct. Earlier on, the top barrier was often, we can't find AI talent. But Deloitte found that shifted. Now, the top barriers are more about those harder organizational implementation challenges. Managing risk, navigating regulation, establishing proper governance.
Which suggests companies are moving beyond just experimenting and are now grappling with the realities of deployment.
Exactly. It's a sign of maturation. But Deloitte also flagged something worrying, the reality gap.
The reality gap.
Yeah, they found that senior leaders often have a significantly rosier, more optimistic view of how well their AI investments are going compared to the managers and employees actually on the ground, dealing with the data messes, the brittle workflows, and the integration nightmares. There's a disconnect between the boardroom view and the frontline reality.
That sounds like a recipe for misaligned strategies and continued frustration.
It certainly can be. It highlights the need for better communication and feedback loops within the organization.
Okay, and finally, PwC. They pinpointed a fundamental issue with how companies are even measuring success, the ROI definition problem.
Right. PwC's point is that many enterprises are failing to properly define and compute the return on investment for their AI projects in the first place. They're not accounting for the true costs or benefits.
How are they getting the calculation wrong?
Well, a few ways. Often they measure each AI project in complete isolation. They might calculate the ROI for, say, a new chatbot, but they fail to allocate the shared costs of the underlying foundational data architecture that might be needed by 10 other AI initiatives.
So they underestimate the true infrastructure cost per project.
Exactly. They also often neglect to factor in the significant hidden costs. The cost of AI model errors and the human oversight needed to catch them, the cost of ongoing model retraining and maintenance, the continuous operational expense, OpEx, including those rising energy costs, to actually run the models 24/7.
So if you're not counting all the costs, the ROI looks better than it really is.
Or you simply can't get a clear picture at all. PwC argues strongly that you must move away from this isolated project view and implement a portfolio approach to AI investment and ROI.
A portfolio approach, like managing financial investments.
Precisely. You need a balanced view across all your AI initiatives. You need to understand the total cost of the foundational investments, like data governance, platform costs, and balance that against the combined returns generated by multiple efficiency projects, innovation experiments, and strategic bets. If you treat every project as a standalone island, the economics often won't make sense, and you'll likely underinvest in the crucial shared foundations.
Okay, that consulting consensus, 10-20-70, rewire workflows, manage pragmatically, fix the ROI calculation. It provides a really powerful bridge from understanding the failures to knowing how to succeed.
It really does.
So let's synthesize all that advice. For the listener trying to navigate this, what's the clear, actionable, strategic playbook that emerges? Let's map out the mandates.
Okay, mandate 1, adopt a strategy-first mindset. This is the absolute starting point. It's the core pivot away from just chasing the latest shiny AI technology.
So don't start with the tech.
Don't start by asking, where can we sprinkle some Gen AI?
Yeah.
Start by asking, what is the single most critical, high-value business problem we need to solve? Or, what's the biggest operational bottleneck costing us money or hindering growth? You must define that business problem and the desired measurable outcome first, before you even think about which AI tool might help.
And based on the current failure rates and complexities, where should listeners focus their initial AI deployment efforts to maximize the chances of getting a measurable, positive ROI?
The consensus is pretty clear on this. Prioritize back-office automation first.
Back office, meaning?
Areas like internal operations, finance processes like invoice processing, IT help desk and ticketing, logistics, maybe some HR functions.
Why start there instead of, say, flashy customer-facing AI?
Because the workflows in the back office are often more structured, more repetitive, and the data requirements can be more standardized compared to the complexities of human conversation or nuanced customer interactions. Crucially, the ROI is often much clearer and easier to calculate. You can measure things like time saved per task, reduction in error rates, faster processing times, maybe even reduced headcount needs in specific areas.
So build confidence and credibility with tangible, measurable internal wins first, before tackling the riskier, harder-to-measure external applications.
Exactly. Get some runs on the board internally, prove the value, learn the lessons in a lower-risk environment.
Okay, mandate 1. Strategy first. Focus on back-office ROI. What's mandate 2?
Mandate 2. Aggressively pay down your implementation debt. You simply cannot ignore this. We talked about how this debt, the skipped foundational work, is the core reason pilots fail when they try to scale.
So how does the listener practically pay down this debt? It sounds expensive and time-consuming.
It is often expensive and time-consuming, but it's non-negotiable if you want sustainable success. It requires real budgetary commitment. It means investing heavily in those foundational prerequisites we keep mentioning, implementing robust data governance policies and tools, building high-quality, reliable data pipelines, and modernizing your data architecture, moving away from fragmented silos towards more unified, accessible data platforms.
This is the unsexy work you mentioned.
This is absolutely the unsexy but utterly critical work. It's tagging metadata, defining data standards, cleaning up legacy data, standardizing APIs, maybe implementing a master data management system, consolidating redundant platforms. It's the plumbing.
And the key is to do this before you try to scale the fancy AI.
Yes. Do the data cleanup and build the solid foundation before you attempt the ambitious enterprise-wide AI scale-up. If you try to build on shaky foundations, you are almost guaranteeing you'll become part of that 88% pilot failure statistic.
Got it. Mandate 3.
Mandate 3. Embrace the 10-20-70 rule in your budgeting. This flows directly from Mandate 2 in the consulting consensus. You have to explicitly recognize that the technology itself is the minor cost component.
So how should a strategic leader actually structure their AI budget to reflect that dominant 70% needed for people and process change?
It means having specific, dedicated line items in your AI project budgets that go far beyond just software licenses and cloud compute costs. You need to budget explicitly for comprehensive workforce upskilling programs, not just one-off training, but continuous learning pathways.
What else for the 70%?
Budget for proactive change management. This means dedicated resources for communication strategies, stakeholder engagement workshops, process redesign sessions. Critically, it means actively involving, not just informing, the frontline employees whose jobs will be impacted. Get their input early on how to make the AI work best in their workflow.
So the 70% budget covers the cost of redesigning the jobs, setting new KPIs, managing the transition, training, basically all the human and organizational heavy lifting.
Exactly. If you only budget for the 10% tech and the 20% data infrastructure, but skimp on the 70% organizational transformation work, you are setting the project up for failure due to cultural rejection, low adoption, or simply not achieving the intended benefits because the processes didn't adapt.
Okay, makes sense. Mandate 4 must be about dealing with that agent washing problem.
Precisely. Mandate 4, build and use an agent watching detection framework. Given that Gartner found less than 5% of vendors claiming agentic AI were the real deal, strategic vigilance here is absolutely paramount. You cannot afford to be deceived.
So practically, what specific questions must the listener ask potential vendors? How do they cut through the marketing hype?
First principle, never take vendor claims at face value, especially around terms like agent, autonomy, or reasoning. Demand concrete proof and specific examples relevant to your use case.
What kind of proof?
Ask them, can your system reliably perceive, reason, and then initiate and manage actions across at least 3 distinct, currently non-integrated enterprise systems like our COM, our ERP, and our support ticketing system to achieve a specific business outcome without requiring human validation for each step?
And if the answer is, well, not exactly, or it assists the user in doing that,
then it's likely not a true agent in the sense we discussed. It might be a useful co-pilot or automation tool, but don't pay the premium or set expectations for full autonomy. You also need to demand technical proof points. Insist on seeing production-grade telemetry from the system. Demand detailed audit logs that show exactly what decisions the agent made and what actions it took.
and get it in writing.
Absolutely crucial. Mandate precise, unambiguous definitions of what constitutes an agent and autonomy within your contracts in the master service agreements, MSAs, and statements of work, SOWs. Define clear, measurable success metrics for the agent's performance in those contracts. Make the vendor contractually commit to demonstrating the genuine capability they're selling. If it turns out to be just a chatbot wearing a fancy hat, you need recourse. Know exactly what you're buying before you sign the check.
Excellent advice. Okay, final mandate. Mandate 5. This sounds like it relates to PwC's point about ROI.
Yes. Mandate 5. Implement a portfolio approach to ROI. You need to move beyond measuring each AI project as a separate, isolated island. That leads to bad decisions and underinvestment in foundations.
So how does this portfolio approach work in practice?
Think like a venture capitalist managing a fund or an R&D manager balancing different types of projects. You need to strategically balance your AI initiatives. On one side, you'll have some high-risk, potentially high-reward exploratory innovation projects, maybe testing a brand new foundation model or a truly novel application. These are your bets on the future.
But those are risky and might not pay off immediately.
Exactly. So you balance them with a larger number of lower-risk, highly predictable, efficiency-focused deployments, likely in that back-office space we discussed. These are projects with clear, measurable cost savings or productivity gains.
And the return from the efficiency projects help fund the rest.
Precisely. The reliable, measurable returns from the efficiency projects help justify and fund the essential, shared foundational investments, the data governance, the platform upgrades that Mandate 2 work. They also provide the financial cushion to absorb the occasional failure of a more ambitious, high-risk innovation project.
So the portfolio approach gives you a sustainable path.
It ensures sustainable, measurable business impact across the AI program as a whole over the long term. It allows you to deliver tangible results today while still placing smart bets on the future, even as you continue to push the technological envelope responsibly. It avoids the trap of having lots of failed, expensive moonshots with nothing to show for it.
That's a very pragmatic and structured way to manage the inherent uncertainty. Okay, so those 5 mandates: strategy first, pay down debt, budget 10-20-70, detect agent washing, and use a portfolio ROI seem like a solid framework.
They represent the hard-won lessons from the field over the last couple of years.
So wrapping this up, what's the big picture? What does this all mean for the strategic landscape of AI and the enterprise going forward?
I think the main takeaway is that the AI market is going through a necessary, maybe somewhat harsh adolescence. The era of Wild West speculation where just having an AI project was enough, that's definitively over.
We're moving into a new phase.
We're moving into a phase that demands rigorous, execution-focused performance. Success is shifting. The winning story in the future won't just be about who has the newest, fanciest algorithm. It will be about who demonstrates the most organizational discipline.
Discipline in what sense?
Discipline in cleaning and governing their data. Discipline in strategic prioritization, focusing on real value. Discipline in managing the human change element effectively. Discipline in demanding proof from vendors and measuring ROI honestly. It's becoming a game of operational excellence as much as technological prowess. That's spot on. That's the critical strategic shift. And maybe to leave you, the listener, with one final provocative thought that ties the financial correction we've discussed back to the physical world.
Yeah.
While the market is busy right now adjusting valuations, sorting the winners from the losers, and skimming off that froth of overhyped applications, the ultimate inescapable constraint on this entire technological revolution remains physical.
The energy and resource constraints we touched on earlier.
Exactly. The staggering and rapidly growing resource consumption of AI. The sheer demand for electricity, for water, for reliable grid access that is acting as a powerful, non-negotiable brake on reckless, inefficient expansion. You can't just throw infinite compute at every problem anymore because the physical resources are becoming the bottleneck.
So this physical reality will continue to force the issue.
It will absolutely continue to force efficiency. It will force companies to be ruthless in prioritizing only those AI initiatives that deliver genuine, measurable, strategically vital ROI. Because the cost of running inefficient or low-value AI will simply become too high environmentally and financially.
So in the years to come, efficient strategic AI adoption.
It won't just be a source of competitive advantage. As these physical resource constraints tighten and costs rise, it will likely become a fundamental prerequisite for organizational survival. Those who can achieve real value efficiently will thrive. Those who can't won't be able to afford to play the game.
A compelling and definitely sobering perspective that brings the hard reality of the grid right into the strategic boardroom.
Thank you. That was a truly deep dive.
My pleasure. It's a critical topic right now.